This week on Wealth Track's Great Investor Series, FBA Crescent Fund's Steven Romick shares the contrarian investment views that make his five-star, go-anywhere, invest-in-anything fund one of the best in the business. He's next on Consuelo Mack Wealth Track. What is different about your approach, do you think, that has allowed you to actually deliver that kind of a risk profile and those kind of returns?
Well, one, I don't really care what other people think about the way we invest. It's a way that makes sense for me.
Right.
And it's the way our team invests, and we have a great comfort level with it. So we're able to really exercise tremendous patience, both in holding an investment, waiting for it to work, or waiting for the appropriate investment to come around. So if cash builds in the portfolio as a byproduct of not finding companies that meet our reward to risk parameters, so be it.
So stop there, though, Steven, because the reality in the marketplace is that you and FBA, First Pacific Advisors, has certainly had redemption issues over the years where you've seen tremendous outflows and people have been screaming at you because you've got too much cash, and institutions have said, we're not investing in you because we want cash. So how do you get away with that? Because a lot of people can't withstand that kind of professional pressure.
I think that our ego is wrapped up in our performance on a long-term basis. It's not we're not trying to beat the market every year. That's not our goal. Our goal is to do as well as the market with less risk. We've been fortunate to have beaten the market, for the last almost 17 years by a pretty good margin, and with less risk, which is, as I said, is our goal. But it's not our goal to beat it every given year, or any given year, or every 2-year period. So to outperform longer term, we believe that you have to be willing to take a stance that might be contrary at times, and that might mean you might be early and you might have to underperform for a period of time. If you look at 1998 and 1999, we look stupid.
No, compared to the tech bubble.
Yeah,
right.
We were down. The only year we lost money until 2008 we lost money was 1999. We were down 5 or 6%, and the market's up 21. But people didn't realize that more than half the stocks actually declined in price in 1999. So when the market was going down in 2001 and 2, we stuck to what it is that we were doing, and we made money in 2000, 2001, and 2002.
You had a great description of yourself. You view yourself as a free-range chicken investor. So what does that mean?
That means that it came out somewhat cavalierly, but what it meant was...
You don't look like a free-range chicken to me, but...
Yeah. What it meant was that we have free range. We can go anywhere. We can invest across the capital structure, asset classes, et cetera. And we're a chicken where we protect first. We're looking to protect capital first, and then worry about the upside second. And that's the way we think.
And that's a very different way of thinking than most of Wall Street, at least most of the Wall Street that I know. One of your leading questions is that you've written many times, and you told me, where do I want to be where I will not lose money? Which again is the opposite of how most people, they want to know, where can I make money, not where can I be where I won't lose money. So how do you apply that as a discipline? I mean, tell us a little bit about what your process is.
Two ways. Two things I think I would mention I think would be important on this subject. One is we think about upside and downside. So if we think that, great, we've got something over there that could be up 30%, but if the downside's 20% that we perceive, then it's a 1.5 to 1 risk-reward ratio, or again, reward to risk ratio. I'm stating it backwards. And that's just not attractive enough to us. It just doesn't work. So we want to get to this 3 to 1 level.
3 to 1, okay.
Before we really are willing to commit capital. I'm generalizing now, because there's different kinds of investments we make, and we think about things differently by investment. But for the larger part of the equity portfolio, that's the way we think. The bonds are a little bit different. So we really think about that aspect of it. Are we getting paid to play? Sometimes if it's that poor reward to risk, then, and things work out well, you can make 30%, but it wasn't worth the risk. If I were to sit here and ask you, if we flipped a coin, and I were to say to you, look, do you want to go and call this bet in the air, heads or tails, my $5, your $5, it's a 50-50 odd bet, and, you could lose it all. Now, some people are gambling, will just take it, but it is a bad bet by our definition. But if I were to offer you 3 to 1 odds, on that, then all of a sudden, okay, it's still a 50-50 chance you'll lose, or that you'll win, but the payoff is asymmetrical, and you can make some decent money if you make a series of bets like that in your life. You're going to end up winning over the long term, assuming you handicapped it correctly. And that's the way we apply it when we think about our investing.
how defensive do you feel that you need to be as an investor? I mean, just your general stance.
I think that we need to be cautiously defensive. Not as like right now, there's so much concern in the air that it's there's a lot of cross currents, but a lot of them are negative. You know, a few years ago, there wasn't much negativity out there. There's more reason for concern when everybody's optimistic. Far less concern when everybody's pessimistic. That's why we were aggressively committing capital back in the winter, you know, of 2008-9.
Right.
Because everybody was negative. Right now, you know, people are, you know, there's more neutrality to it. There's a lot of people who are negative, a lot of people who are positive, and, you know, we think that we are finding some things to do that I think we're going to make very good money in over the next 5 years. I don't know if we're going to make it next week or next month or over 3 months or even a year, but we're comfortable that we're going to make money in the investments that we have over the next 5 years. And we could be wrong. We hope that when we're wrong in certain investments, we will be wrong. I'll restate that. We will be wrong on certain investments, but we just hope that we manage the downside. We don't lose too much for when we're wrong, and it's more than made up for this times when we're right. Everybody's wrong. I mean, I look at you know, at Berkshire Hathaway and Mr. Buffett's company, and the very name of his company is a failed textile mill. Now, I believe it, if I recall correctly, it had a positive IRR to that investment, but I'm sure he didn't invest in it at the point in time when he bought it, expecting it to have to close it at some point in time. And I believe it was a very hard decision for him. So we all have investment successes, and we all have investment failures. We just need to make sure that the failures don't destroy us.